The world is entering a moment that every major financial institution has whispered about for months. A slow, silent liquidity crunch that is building behind the scenes, while the public focuses on politics, celebrity drama, or whatever headline distracts them next. Liquidity is the oxygen of the global financial system. It is the fuel that keeps banks lending, governments functioning, corporations rolling debt, and markets moving. When liquidity disappears, everything begins to suffocate. And right now, the oxygen level is dropping. This is not a collapse in one day. This is a slow tightening coil. Central banks worldwide have spent years pumping money into the system. Now they are pulling it back. Global liquidity is rolling over at the exact moment the world economy is slowing down. Funding costs are rising. Bond markets are unstable. Dollar access for non-US banks is thinning out. Emerging markets are showing stress first, but the cracks are spreading into Europe, Japan, and even the United States. Look closer and you see the shift. Hedge funds that borrowed cheap money for years are now facing margin pressure. Private credit markets that exploded during the low-rate era are now showing mismatches between investor withdrawals and real liquidity on hand. Banks look stable on paper, but their exposures to non-bank funds and hedge positions are larger than ever. Even the IMF is warning that a liquidity risk event could trigger a chain reaction across insurers, asset managers, and sovereign markets. The world is entering a zone where money is becoming expensive again. And when money becomes expensive, debt becomes dangerous. Governments, corporations, and markets depend on funding that must be constantly rolled over. If the liquidity well runs dry, rollovers fail. That is how crises begin. Not with panic at first, but with tightening at the margins that slowly spreads until something breaks. Here is the part they really do not want you to notice. Liquidity crises do not only expose the weaknesses of the old financial system, they reveal the need for something new. When cross-border funding freezes, when dollar swap lines get stressed, when settlement delays multiply across borders, the world begins to search for faster, cheaper, more efficient ways for value to move. That is where alternative rails enter the conversation. And one of those rails is XRP. In a world where banks fight for access to short-term liquidity, a digital asset that can settle value in seconds, move across borders with no friction, and operate independently of legacy plumbing becomes more than a speculative token. It becomes infrastructure. The global liquidity crunch does not slow down tokenization. It accelerates the need for it. When the old pipes fail, new pipes are installed. This is why institutions are watching. This is why banks are testing digital rails behind the scenes. This is why regulators are preparing frameworks for digital settlement networks. Because once the liquidity pressure becomes acute enough, the world will not wait months for upgrades. It will flip to whatever works. And that is the story LTL tells. A world hitting a liquidity wall, a financial machine straining under its own weight, funding markets growing thin, central banks trying to contain stress while new technology waits on the sideline. The global liquidity crisis is the pressure point. Digital settlement is the release valve, and XRP stands exactly where those two forces meet. The world is moving toward a moment of decision. When the liquidity lights flicker, everything changes. And the next chapter of that change is unfolding right now.